In this video, I am going to discuss about internal rate of return. Internal rate of return is the discount rate at which the NPV for a project or investment is zero. We now know what is NPV technique, net present value. NPV can be a positive value, it can be zero, or it can be negative value. We only accept the positive NPV projects. Zero NPV and negative NPV projects will be rejected. This discount rate is the cost of capital of the project or investment. Internal rate of return is a percentage value, which means this is a relative value. The higher the internal rate of return, the more profitable the investment is considered to be. So, when evaluating different investment opportunities, the one with the highest IRR would generally be the most attractive option. Under NPV technique, we calculated the absolute return from a project. Here we are going to calculate the cost of capital or the discount rate at which the NPV will be equal to 0. This is how we can illustrate the IRR. Y-axis depicts the NPV value. X-axis depicts the cost of capital, or we can consider as discount rate. So this is the point we are going to calculate. As we now know, there can be positive NPV values and there can be zero NPV value and there can be negative NPV values. So we are going to calculate the rate at which the NPV equals to 0. Now let's discuss about the IRR formula. This is the IRR formula. This looks a bit complicated, but don't worry. Once you do some example questions, you will get the hang of it. This is really simple. So the IRR equals to capital A plus NPVA divided by NPVA minus NPVB multiplied by B minus A. These two brackets are very important. Be mindful to use them when you are calculating the IRR. If you don't use these brackets, you will get an incorrect answer. So, capital A is the cost of capital of the positive NPV. B is the cost of capital of the negative NPV. NPVA is the positive NPV value. NPVB is the negative NPV value. This cost of capital is the discount rate simply. Here now we have included the NPVA and NPVB value. In order to calculate the IRR value, we need to find the NPVA value, which is a positive NPV value, and we need to find the negative NPV value, as well as the respective cost of capital for those two NPV values. These are the steps to calculate the IRR. First, calculate the positive NPV for cost of capital that you selected. Select any cost of capital that will produce positive NPV. Usually start with 5%. This means now you have to calculate a positive NPV value for given cash flows using any cost of capital value, which means now you have to calculate a positive NPV value for given cash flows using any cost of capital. This is up to you. You can usually start with 5%. This means you are considering the cost of capital to be 5% and calculate the NPV. The next step is to calculate negative NPV for cost of capital that you selected. Select any cost of capital that will produce negative NPV. Cost of capital will be higher than for positive NPV cost of capital, which means if we select 5% for positive NPV value, the cost of capital for negative NPV will definitely be higher than 5%. You will understand these concepts when we do an example question. So the final step is to assign the values to the IRR formula and calculate the IRR. Now let's do this example. Cash flows are given. The year 0 cash flow is a cash outflow. Then year 1, year 2 and year 3 cash flows are given. What we have to do first, we have to calculate a positive NPV value. In order to do that, we need to select a cost of capital or a discount rate. So let's select 5%. Now what we have to do, we have to calculate the NPV value for the given cash flows in the example. Now you know for year 0, the discount factor is 1. Now let's refer to the present value table and find the discount factors for year 1, 2 and 3. So this is the present value table. The cost of capital is 5%. So it will be this column and these are the discount factors. 1, 2, 3. 0.952 for the year 1, 0.907 for year 2, 0.8642 year 3. So the NPV for 5% cost of capital is a positive value. So the first step is done. Now what we have to do is we have to calculate for a negative NPV value. First, let's assign these values into the graph so you will understand this better. So A equals to 5%, NPV equals to 230.55. 230.55. So we have found the positive NPV value and the respective cost of capital. Now we have to find the negative NPV value and the respective cost of capital. So the cost of capital for the negative NPV value is definitely higher than the 5%. See, 5% is here. B value is here. So it has to be higher than 5%. So let's consider 20% for negative NPV value. Let's see, will it give a negative NPV value? Now what we have to do is we have to assign the 20% cost of capital for the same cash flows and see if the net present value is negative or not. So the discount factor is 1. Here is the 20%. So these are the discount factors. So the NPV for 20% cost of capital is negative value minus 37.6. So now we have found a negative NPV value and a respective cost of capital. Selecting the cost of capital for the calculation of NPV values are totally up to you. Let's say this 5% cost of capital value gave us a negative NPV value. What you can do is use this 5% and the negative value for the calculation and then calculate for positive NPV value. So the cost of capital will be lesser than 5%. And let's say we get a positive NPV value for 20% cost of capital. What we can do is we can now increase the cost of capital value and recalculate the NPV value. If this gives us a negative NPV value, you don't have to worry about calculating all this in your exam because you will be not required to do these lengthy calculations in your exam. You have to have the understanding of what is the IRR formula and how to use this formula in order to calculate the IRR. So the rate is correct. So the negative NPV value is 37.6. Now we can assign these values into the IRR formula and calculate the IRR. NPV A divided by these brackets are very important. Now let's assign the values to this formula. We need to convert the percentage values into decimal values because we cannot use percentage values as it is. So 5 divided by 100 plus Very important thing to note here, because there is a minus value here, and the next value is also a minus value because it is a negative NPV value, which is 37.6. So you know what will happen if two negative values multiply. It will become a positive value. So this whole denominator of this equation will be plus 37.6. So when you calculate IRR, simply put the positive sign into your calculator without having to input minus and then again a minus, because sometimes you might forget to use one minus value. If that happens, the answer will be incorrect. So simply add these two NPV values in the denominator. So this will give us 0.17896. This is a decimal value. Now we have to convert this into a percentage value because IRR is a percentage value. We can simply multiply this by 100. IRR equals to 17.896%. Let's check this value with the graph. So the IRR is here, which means it has to be a value between 5 and 20. So we got the 17.896, which means it is between these two values, which is an acceptable value because it is between 5% and 20%. So this will be the IRR value. Exam points for IRR calculations. You need to convert the percentage value into a decimal value, and also in the denominator there are two negative values multiplying each other. So you need to be mindful these negative values will become a positive value. Remember to use the parentheses correctly, unless you will get an incorrect answer. And finally, you have to convert the decimal answer into a percentage answer. You can do this by multiplying the answer by 100. Let's discuss about pros of IRR. Measures profitability. IRR is a widely used financial metric that helps investors and analysts to evaluate the profitability of an investment. It takes into account both the timing and amount of cash flows, which gives a more accurate representation of the expected return. Easy to interpret. IRR is expressed as a percentage, making it easy to understand and compare to other investment opportunities. Considers time value of money. IRR considers the time value of money, which means it takes into account that the value of money decreases over time due to inflation. Provides a hurdle rate. IRR provides a minimum acceptable rate of return for an investment, which is known as the hurdle rate. An investment with an IRR that is lower than the hurdle rate is not considered acceptable. Now let's discuss about cons of IRR. Multiple solutions. IRR can have multiple solutions, which means there can be multiple rates that result in the same net present value. This can make it difficult to interpret the results and can lead to different conclusions. Ignores reinvestment rate. IRR assumes that all cash flows are reinvested at the same rate as the IRR, which may not be accurate in practice. May not account for risk. IRR does not account for the risk of an investment, which is an important consideration when evaluating investment opportunities. Can be misleading. IRR can be misleading in some cases, such as when the cash flows are uneven or when there are significant changes in cash flows over time. Thank you for watching. See you in the next video.